Hi guys, this is Richard Yi. Today is May 8th, 2011. Happy Mother's Day to all the mothers out there. Well, I guess most of them won't be that happy, because nowadays it's, increasingly expensive to shop for food. So today I want to talk about inflation, which is, kind of related to food. And on April 27th, the chairman of Federal Reserve, Ben Bernanke, in a Fed press conference, claimed that, and it says here, measures of underlying inflation, though having increased modestly in the recent months, remain subdued, and long-term inflation expectations have remained stable. Well, I don't agree with him. I think inflation in the U.S. will be more serious than before, and the holders of US dollar will get wiped out as the value of US dollar diminishes. Just to prove my point, I got a few graphs from St. Louis Federal Reserve website. So the first graph here represents the percentage increase of inflation compared to a year ago. I'm using all items or full CPI so that it also reflects price increase in both food and energy, which are essential to economic analysis because when inflation hits, food and energy prices will rise the most rapid because sure, people can cut back on other consumption, but they cannot cut back on food and energy. So therefore, they will rise the most rapid. And they're not included in core CPI calculation, which made the core CPI calculation inaccurate, I think. So anyways, so this graph starts in August 2008 when the Federal Reserve starts the first round of quantitative easing, which lasted till March 2009. As we can see, inflation in the US was actually decreasing quite rapidly when this government was printing money to boost the economy. Well, then why doesn't inflation go up then, right? Because logically, if you increase money supply in the country while the amount of goods stays the same, doesn't inflation goes up? Well, actually, the reason behind why that doesn't is actually quite simple. Since the US dollar is the world reserve currency, and China, which is its main trading partner, has an export economy, therefore, stabilization in the exchange rate between dollar and renminbi will actually benefit Chinese exporter because in that way, right, those Chinese exporters can have a better cost control, and when they're doing their future business planning, it can be more accurate since its exchange rate is constant. Therefore, the Chinese government maintained a fixed currency exchange rate with the U.S., which means increase of money supply in the U.S. must also bring an increase in money supply in China, right? The way they do it is, when there's more U.S. dollar circulating in the world, while the amount of renminbi stays the same, right? Definitely, exchange rate. If it assume that the Chinese central bank does nothing, then definitely exchange rate will adjust itself to reflect the supply of both currency, right? So the exchange rate between RMB and US dollar will increase. So Chinese central bank will then conduct open market operation to buy US dollar by printing RMB, Chinese yuan. Well, thus decrease the amount of dollar circulating in the economy and increase the amount of Chinese yuan so that they can maintain that kind of fixed exchange rate. Besides, don't forget China has an export economy. So when the U.S. trade with China, U.S. export worthless paper money and receive goods from China. So in a sense, the U.S. export is inflation to China while receiving additional goods, which kept its inflation level low in the U.S. So that is why we don't see an increase of inflation in the U.S. just yet. However, the Chinese are not stupid. So in June 2010, the Chinese government allowed the renminbi to slowly appreciate against the US dollar, which in turn made it harder for the US to export inflation to China. In November 2010, the Federal Reserve started the second round of quantitative easing with the size of $600 billion, same as the previous one. As we can see in this graph, this time the inflation has actually been rising due to appreciation of renminbi against the US dollar, which made it really hard for US to export inflation, so the inflation stayed in the United States. I think the upward momentum for inflation in the U.S. is very strong because many rounds of stimulus spending, 0% interest rate, and quantitative easings. The U.S. economy is very dependent on cheap money. So as long as the economy stays this weak and they're dependent on cheap money, in the long run, the U.S. government must keep increasing the money supply, even under the condition that inflation cannot be fully exported. So in the future, I'm expecting higher inflation in the U.S. and higher prices in dollar-dominated asset, namely commodities. I think it would be a question of time rather than yes or no for surging commodity prices, and especially silver seems really attractive recently because in the past week it has gone through a correction, and now I think it's a really good time to long silver. Thanks for watching, and if you have a chance, go buy some commodities. I will be vlogging again soon. Bye.